So, Natalie, what's your role at UK Landlord Tax?
So I'm a tax advisor, so I advise clients on how best to structure their property investment plans. I work alongside yourself and Pav, and I also create all of the content for our social media accounts, LinkedIn, Facebook, Instagram. So yeah, I'm in control of all of those content.
We get a lot of clients approaching us to set up a deed of trust. So can you start off by explaining exactly what a deed of trust is?
A deed of trust is an arrangement put in place by property owners to split the beneficial interest differently to how the legal ownership is structured, specifically for tax purposes.
Great. As a married couple, why would someone want to use a deed of trust?
So specifically for married couples, if you have one partner that is a high rate taxpayer or one that doesn't work, for example, you may wish to shift all of the beneficial interest onto the partner that doesn't work and declare all of the rental income in their name because you can utilise their personal allowance.
So it's an effective way for, let's say, a married couple to utilise all their tax allowances in a tax efficient way?
Yes, definitely.
Can you give me an example?
So, for example, a husband being a high rate taxpayer, they've had a baby, the wife's not currently working because she's at home looking after the baby, her personal allowance is going wasted, there's a rental property in place that may be owned solely by him or even 50-50. They can shift the beneficial interest onto the wife. She can declare all the rental income, utilise that personal allowance, so that first 12,570, and then pay tax at the basic rate, meaning they are taking home more money each month from that rental property.
Great. So with a deed of trust, you're shifting what's called the beneficial interest.
Yeah.
Can you just explain what that is, so anyone listening?
So the beneficial interest is the income that's being generated by the rental property as well as all the expenses. So the expenses must be declared in the same way as the beneficial interest. So all the income and expenses, if you change it to be 100% in your wife's name, have to be declared in the same way. But this does not alter the legal ownership. So the legal owner remains the same. The person that's being added to the beneficial interest is not added to the legal title if there's a sole owner restriction in place. So for example, if the husband owned the property solely and he's transferring 100% of the beneficial interest to the wife's name is not added to the legal title. He's still the legal owner.
And do they need to get clearance from, let's say, a mortgage lender?
We always advise that you speak to your mortgage lender. It's very rare that your mortgage company would say no to a deed of trust because they've become more common over the last 5 years.
And I suppose because it's not an actual change in the legal title, is it?
No, for them, as long as the mortgage is being paid, all you're doing is you're altering the beneficial interest for tax purposes only. You're not changing the legal ownership. But we do recommend you ask anyway, just so that there's no nasty surprises when you come to remortgage, because you do have to put in place a Form A restriction with Land Registry. So when you do come to remortgage, that restriction will show on Land Registry and your mortgage lender may query that.
So what are the steps involved, Nat, in setting up a deed of trust?
So the first step would be to have the deed drawn up and to split it how you wish to split it.
And is that something you would do, we would do here at UK Landlord Tax?
Yeah, so it is a service we offer. It's an all-inclusive service that we offer from start to finish. So we offer the tax advice that comes with whether a deed of trust is beneficial for yourselves, as well as the forms that are required. We do complete all the forms for you. We just ask you to sign them and send them back to us. And then we do also submit everything to HMRC on your behalf.
Okay, so what are the steps then in terms of setting up a deed of trust?
So the first step is to draw up the deed, which would list the beneficial interest, how you wish to split the property. It includes all the property information, such as the purchase price, the mortgage lender, the date it was purchased, the title deed number. It also includes the names of the people who are being listed on that deed and how the income is going to be received, as well as the legal implications of splitting that income.
Okay, so once the deed of trust has been created, what's the next step?
So a Form A restriction needs to be put in place with Land Registry. Dependent on how the property is currently owned, that would either be a Form SEV or a Form RX1.
Okay, why do they need this form of restriction? Is it to do with tenants in common and joint tenants? So what's the issue there?
So in order to put a deed of trust in place, the property must be owned in tenants in common.
Right.
So you put...
What is tenants in common for people listening?
So tenants in common and joint tenants are different because the joint tenants is if you've purchased a property, you just own it 50-50 as marital partners. And then when one spouse passes away, it will automatically pass to the surviving spouse. Tenants in common would be if you own it in different splits to 50-50 and they follow the rules of your will rather than just being passed straight down to the surviving spouse.
So it's important for someone to understand the difference between tenants in common and joint tenants.
Yeah, and in order to be able to put that deed of trust in place, the property has to be owned in tenants in common, which is what the Form A restriction will do.
Okay, so step 1, create the deed of trust. Step 2, sort out the tenants in common using, is it restriction A, is it?
Form A restriction
Form
with land
A restriction.
registry.
What's the next step?
So a Form 17, which will basically list the names of the people who are going to be declaring the income straight to HMRC. This must be submitted to HMRC within 60 days of the date of the deed being signed.
So it can't be backdated or anything?
No. So it has to be as soon as the deed's been signed. The Form 17 is the next step after the Form A restriction, and it has to be submitted to HMRC within 60 days of the date of the deed being signed. So, for example, if it was signed on the 13th of March 2026, HMRC need to have received that Form 17 within 60 days of that date.
What happens if the form isn't sent to HMRC within that 60-day period?
Then the deed is invalid. HMRC won't accept that as a valid deed of trust, meaning you can't declare the income for tax purposes in that way. It reverts back to its original structure.
So Natalie, why is the 60-day period to file the deed of trust and the Form 17 to HMRC important?
This is in HMRC's guidance. It's their manual that's set out for Form 17s. If it's not submitted within 60 days of the date of the deed being signed, then HMRC will declare that deed of trust as an invalid deed of trust.
Right.
And you can't declare the income as you wish in the deed for tax purposes. You would need to start again.
Okay, so it needs to get in within the 60-day period from the date of the deed.
The date of the deed being signed, yeah.
Otherwise, it's invalid and the whole process has to start again.
Yeah, so you then have to sign the deed in the date that you're signing it because you can't sign it retrospectively. It has to be signed. You can't backdate it. It has to be signed at the date that you're signing it.
So, step 1, create the deed. Step 2, complete Form A restriction. If the property is in joint tenancy, it needs to be tenants in common.
Yeah.
And then step 3, complete Form 17 and then submit that to HMRC with the deed of trust.
Yep.
Okay, then what happens?
So then, however you've decided to split the beneficial interest, you need to declare a self-assessment tax return each year, declaring the income in that way. So if, for example, a husband has transferred all that income to his wife, the husband can then come out of self-assessment from the date the deed has been signed, and the wife would need to declare a self-assessment from the date the deed has been signed.
Do HMRC acknowledge the deed of trust?
Sometimes, yes. Sometimes we do receive them back and say, thank you for writing to us. We've added this to the client's file, but not always. So we always explain to clients, don't bank on getting a response. But if we haven't had a response, you can still declare the income exactly how you wish, provided you've done that Form 17 within 60 days.
So when we're handling this for clients, what do we do to ensure that we can prove the date of the submission to HMRC?
So we always allow enough time for post to get to HMRC. Generally, clients want a deed of trust in place as soon as possible, so they come back to us quite quickly with all the signatures. But it is also important to note that we have to send the original Form 17 to HMRC. It has to be wet signed. It can't be a scanned copy. So clients do have to post it back to us. So we do tell clients as soon as they've had their Form 17 to send it back to us as soon as possible. When we receive it back, we do send it to HMRC with a cover letter explaining that this is a Form 17. We've put a deed of trust in place. We provide them with a copy, and then we send it with more than enough time within that 60 days to make it valid.
Do you normally send it by some kind of registered post?
So we always send it registered post just to make sure it gets there on time. And if we do receive any back from HMRC, we make a log that we've had it back.
I know that stamp duty is often an area where clients get confused. So what is the treatment of stamp duty when doing a deed of trust and transferring the beneficial interest?
So for stamp duty purposes, the deemed consideration would be the prorated mortgage balance.
So, for example, if there's a £500,000 mortgage outstanding, how would that be affected by the deed of trust?
So if there's a mortgage of 500,000 and the property is solely owned by a husband and he wishes to transfer 50% of that property to his wife, the deemed consideration for stamp duty purposes would be £250,000.
Ah, right. So they'd get the first 125,000 free under the current rates of stamp duty, but there'd be an assessment of stamp duty on the balance.
On the balance, yeah. But
do they have to pay the higher rate charge too?
No, so the stamp duty between spouses is only at the standard rates. So that's why the initial 125,000 would be stamp duty free, and anything above that is at the standard rates of stamp duty.
If there is a beneficial interest change from a husband to a wife, is there any capital gains tax?
So between husband and wife, it's calculated on a nil gain, nil loss basis. So there's no capital gains tax between husband and wife.
It's one of the benefits of being married, is it?
Probably the only benefit, to be fair.